I'm Darren Sugiyama, one of the managing partners here at Landsmark Capital, the most mathematically sound premium financing intermediary in the industry. Last year was an interesting year to say the least. COVID-19 certainly changed all of our lives in so many different areas, including the life insurance industry. And then AG 49A comes along, and that has definitely made things interesting as well. In fact, if you've run a carrier illustration lately for an accumulation and income case, you've probably noticed that income drawdowns in carrier illustrations are less than half of what they used to be. And if you're looking at a premium finance case for death benefit purposes, you probably also found that paying off the third-party loan is happening much later than pre-AG 49A conditions. So like I said, lots of changes happening right now, some for the worse, but also some for the better. So on today's webinar, I'm going to talk about some of these challenges and some of these changes and how we've adjusted to this new environment. And quite frankly, how we've really skated to where we knew the puck was going and how we're fully equipped to help you sell your big premium financing cases in a way that no other premium financing intermediary can. Now, I know that's a big statement, but what I'm about to show you on this webinar is going to confirm every big claim that I've made. So let's go ahead and get started. Now, if you've seen any of our webinars in the past, you know that we do some pretty obsessive back testing and stress testing. Well, we've upgraded our software, massively upgraded our software. And now we look at 121 different 40-year periods of actual S&P 500 performance. And we model volatility, participating loan arbitrage, both positive and negative, as well as multipliers. So very controversial subject. And we're going to get into how we model that. We've really gained the reputation of being what I would call the most sophisticated premium financing firm in the space. And we have great relationships with all of the carriers. In fact, we're one of only 8 firms in the country endorsed by National Life Group. And we're one of only 7 firms in the country endorsed by Penn Mutual. And the fact that Penn Mutual is such a conservative carrier really tells you a lot about our relationship with them and what our platforms are really built on. We've also done a ton of seminars and webinars for both carriers and IMOs in our industry. In fact, in 2020, we were one of the featured speakers at Pacific Life's National Symposium as the subject expert on multipliers and how AG 49A is affecting our industry. We've also done sponsored events for Penn Mutual, Nationwide, Simplicity Life and EPG, FFR and Peloton and CPS, and dozens of other organizations. And, I think the reason why we've gained this reputation is really due to 3 main things. First of all, we're not a one-trick pony. Okay, we have 4 different premium financing platforms or strategies, if you will. And some of them are built for death benefit and estate planning, and some of them are built for accumulation and income drawdown type of scenarios. So each case is a little bit different, right? Just like every one of your clients is just a little bit different. And so we really take the time to co-counsel with you on how to design the perfect premium financing strategy for each one of your specific clients. Now, whether it be the size of the case or the type of the loan they want, by the way, we can do annual variable rates as low as 1.5% right now, or we can do 10-year fixed rates as well. It really depends on the type of collateral that your client wants to post, if they're willing to move that collateral to the lender for a lower borrowing rate, or if they don't have any collateral at all to post. We have some programs for those types of clients as well. Again, everyone's different. So, we have 14 lenders on our platform. So we shop the rate to get your clients the very best deal available. And then we also have our proprietary software that I'll talk to you about today as well. So let's go ahead and take a look at a case study here. This is a 63-year-old male client rated at standard non-tobacco, and he needs $20 million of death benefit. So in this webinar, we're going to take a look at our first dollar financing program. This is only one of 4 different lending platforms that we have. If you want to check out our other platforms at the end of this webinar. You can go to our website at lionsmarkcapital.com. You can click on our programs at the top of our homepage, and you can read up on how each of these 4 different premium financing platforms work. But in this particular webinar, we're going to focus on first dollar premium financing. So on this platform, with this client, we're going to start off with a $36.8 million net face amount. It's actually $40 million in gross face amount, but because we're borrowing $3.2 million in premium per year at the start of the first year, the net death benefit is just over $36 million. Okay, in this program, the client would pay the interest out of pocket each year. And as you see on a case this size, or quite frankly, any case where the borrowed annual premium is north of $1 million, we're getting annual renewable borrowing rates right now, sub 150 basis points, which is incredible. Money is so cheap right now, which is why premium financing is in such high demand right now. In fact, you may be having clients that are asking you questions about premium financing. And if they're not, there's actually a good chance that they're talking to someone else about it. So I highly recommend that you bring this subject up and talk to your clients about the concept of premium financing right now. Of course, we have the estimated collateral that the client would have to post there. And then we are showing the third-party lender being paid off in policy year 20. Okay, now in this design, the death benefit hits a low point of $21 million in policy year 33. Again, this client needed $20 million of death benefit. And they hit that low point of 21 million at age 95, which is policy year 33. So if you remember, again, the client wanted $20 million of coverage. Well, with premium financing, we can start with a much larger initial death benefit and then make sure that the actual death benefit requirement is met at the policy's low point. Now, you may be asking, Darren, if the client only needs $20 million of death benefit, why are you starting off with $40 million? I mean, Jesus, that's double the death benefit requirement. Well, there's a reason. And a lot of it has to do with these new AG 49A guidelines. And we're going to get into the specifics of this new regulatory kind of restriction and how that's affected premium financing. Again, in this scenario here, we have the interest paid out of pocket by the client, okay, and the death benefit net of loans in this column here, with the low point just over $21 million, again, at age 95 in policy year 33. Now, the reason why we're showing this is we're going to take a look at an all-pay GUL for $21 million in death benefit also. Okay, on a GUL non-financed policy, the premium is going to be just over $557,000 per year, which is a little over $22 million in total cost over a 40-year period. I would actually, if they make it past age 100, they are going to pay into this more premium than the actual death benefit that they pass on to their heirs. Versus in a premium financing design, in our premium financing design that we're looking at here, they would only pay $11 million out of pocket for an initial $40 million in face with a low point of $21 million in death benefit. Okay, so I know what you're probably saying is that the guy's probably not going to make it to age 102, right? 40 years into it. Fair enough. If he only makes it to say age 85, that's still for the GUL, that's almost $13 million in premium costs versus $11.4 million in out-of-pocket expense in our premium financing design. And so if we look at the right side of the screen, I think this graph is really cool. The orange represents the level $21 million of coverage in the GUL, and the green is the death benefits of the premium financed IUL, or I should say the net death benefit, net of loans, in the premium financed IUL. So the client would have substantially more death benefit in the first 20 years or so, paying less than the GUL cost. Now, you could say, well, the client really only needs 20 million. He's overinsured. Well, okay, fair enough. what's the definition of overinsured? I would say this particular client is worth well over $100 million, the one we're looking at here. When we talk about the concept of being overinsured, no one is going to complain about having more death benefit. What they're going to complain about is paying for more death benefit. And so when you're premium financing, the client is actually paying less out of pocket than they would for a non-finance policy. But what comes with that initially is substantially more death benefit than they really even need. And then when the policy hits the low point death benefit, that is right on target with what the client initially said they needed. So again, the design we're looking at here, this is post AG 49A. Again, a lot of things have changed. If you looked at premium financing cases pre-AG 49A, which is like right around October of 2020, of the year 2020, things looked a lot different than they look. Here we are in 2021. And again, we'll get into the details of why that is. So again, with the premium financing program, he's less out of pocket than the GUL. He's got more coverage and hits the same low point, or at the low point hits the same death benefit as the GUL. So I think this slide is really, really compelling. Again, there's the $21 million low point. So a couple of questions that most people have when they look at premium financing for the first time. One is, why are we paying off the loan in policy year 20, right? Why not do this sooner? Or why not do this later, quite frankly, right? But let's focus on why not do it sooner. There are several reasons why this is the case in today's environment, and they really make zero sense in reality. But let me explain why they are relevant in today's regulatory climate. Okay, one is AG 49A. If you're not familiar with that, it's a law that was passed just at the end of last year that limits the illustrated spread between the participating loan rate and the illustrated index credit. In other words, what the policy is crediting relative to the loan rate when you take out policy loans to pay off the third-party lender, this new law limits that spread to 50 basis points. Now, pre-AG 49A, this restriction did not exist. And so that additional little positive arbitrage allowed you to typically pay off the third-party lender somewhere between policy year 13 to policy year 16. Well, post AG 49A, no longer the case. You cannot make this work in a carrier illustration. Typically, you're gonna have to show the loan paid off after 20 years or so. Again, has nothing to do with reality, because typically the par loan rate spread between that and the index credit is gonna be a lot greater than 50 basis points. Okay. Second reason is that if you're going to advise your client to take advantage of a multiplier bonus concept, some of these IULs have a multiplier bonus. AG 49A does not allow you to illustrate the multiplier benefits if you're going to run the illustration with the multiplier benefit on, and this part's crazy, the policy in the carrier illustration is going to incur the multiplier charges but not show any of the multiplier bonuses, which makes you think through this for a second here, right? Why would anyone show a carrier illustration with a multiplier on it when you're going to get charged for it in the illustration and you're not going to be able to show the client the benefit, right? That's why a lot of these carrier software programs are starting to see a huge influx of non-multiplier illustrations run, because the multiplier version of the illustration doesn't even show the multiplier benefit. It's ridiculous. This makes no sense whatsoever. This is like trying to sell a 700 horsepower Lamborghini when the product brochure says it only does 300 horsepower. Again, completely nonsensical, but this is the regulatory environment that we're living in right now. So this is where I get to have my I told you so moment. For the last 7 or 8 years, I've been aggressively and transparently showing clients these simulated synthetic lookbacks where we could show how policy charges, policy credits, multipliers, how all these policy design elements would work in a real world scenario with volatility, right? So we've been doing all these look back, really cool reports. Some people thought they were interesting. Some people thought they were pretty cool. But I think a lot of folks looked at it and said, it's nice and everything, but I'm doing just fine selling insurance the way I've been selling it. Well, this year, that is not happening for most insurance agents because AG 49A limits that spread. And so in accumulation and income drawdown type of policy designs, the carrier illustration looks terrible. You're able to pull out, in most cases, less than half of what you're used to be able to pull out in income drawdowns. If you're doing premium financing, because of that restriction, you're not able to pay off the third-party lender any sooner than usually year 20. So this has completely changed our industry. This is where Landsmark Capital really shines right now, because we have our proprietary software where we can model the concept of how these floors and caps and multiplier charges and multiplier credits actually work. Again, we've been running these lookbacks and these backtesting reports for over 7 years now. I mean, the reality is, how in the heck are you supposed to explain to a client how a floor and a cap works without this type of software, or how charges work, asset-based charges, or how multipliers work, right? If you don't have the software that we have, you literally cannot do it, which was one of the main reasons why I think you ought to be doing your premium financing cases with us here at Landsmark Capital, because we're the only ones in the space that can model this so that your clients can see how these premium financing designs hold up with volatility. Again, we come from an educational background. I used to be a high school teacher, if you can believe it, back in the day. I've got a master's in multicultural education. And so I really have approached our insurance industry from an educational standpoint, with the goal of really helping clients understand what it is that they're signing up for. And that was really the spirit in which we created these tools and these backtesting reports, et cetera. Again, like I said, we've gone through a massive upgrade in our software where we literally now go back 50 years and say, okay, what would have happened had you started out on January 1st, 1970? And then what would happen if we ran that forward 40 years? Okay, if we ran that forward 40 years, that would put an endpoint of December 31st, 2009. So those are all the S&P historical returns during that 40-year period. During that 40-year period, the compounded annual growth rate of the S&P 500, just the raw S&P 500, not including S&P dividends, was 6.43%. So that's one 40-year period. What's interesting is if you really look at how IULs work, depending on when the segment starts, in other words, when the policy is put in force and the segment starts, you could have two different clients start on in different months in the same year, and the index annual point-to-point credits can be completely different. So in other words, in this model here, if you didn't start on January 1st, 1970, but you just started 1 month later, let's say you started February 1st, 1970, that, and you put ran that out for 40 years, that would put an endpoint at January 31st, 2010. So what we did is we decided to inch forward 1 month at a time and run every single 40-year period with a start date on the first day of the starting month. And we did that all the way up into December 31st, 2019, okay? What this did is it literally created 121 different 40-year periods within that time frame. So what we do is we take the policy data from the carrier illustration, we dump it into our software, and then we model how things would have performed over 121 different actual historical periods of the S&P 500. We look at how that would have looked, and then we identify the best 40-year period within that period, those 121 different runs, based on the compounded annual growth rate of the raw S&P. So again, we're ranking every single one of those 121 different 40-year periods. We're ranking them best to worst based on compound annual growth rate of the raw S&P 500, not including dividends. Okay, so we identify the best one with the best compound annual growth rate, the worst one, and then we also tag the median one of those 121 different 40-year periods. Right now, how's that for due diligence? It's a lot of different 40-year periods. I wish every product I bought the company could run me 121 different scenarios of what could happen if I bought a product. But anyway, to be clear, we are not creating our own policy illustrations. Okay, this is 100% within the realm of compliance when it comes to AG 49A and all the regulatory demands, because we're not modeling a policy illustration. Okay, what we're doing is creating a hypothetical synthetic asset. Okay, so this is like a fictitious investment. Okay, and we're modeling this fictitious investment. Again, we call it a hypothetical synthetic asset. We're modeling it based on actual historical S&P returns. Again, this is not an IUL. It's a fictitious investment account that acts as a proxy for an IUL. It just has certain features, like charges and fees and crediting methods that behave very similar to certain actual IUL parameters. Our disclaimer is that this report is not intended to model any specific investment fund, index fund, life insurance policy, annuity policy, or any financial instrument or product for that matter. This is merely a report to teach interested parties how different charges and crediting methods work, with the intention of promoting a better understanding of how these different features may affect future financial outcomes, in good, bad, and ugly scenarios. Emphasis on ugly scenarios, by the way. So this is purely for educational purposes only. Okay. So of these 121 different actual historical sequences of returns, we're going to focus on the worst one, right? This is the worst 40-year period, or the 40-year period with the worst compound annual growth rate of all of those 121 different 40-year periods. The worst one started out on October 1st, 1971. So here we have the S&P 500 historical returns during that period. And then we apply the floor and cap, and we multiply that outcome by the multiplier factor, if there's a multiplier bonus feature on there. And that gives us what we call the effective index credit, or the applied index credit. So then we look at the account value net of loans in the far right-hand column in the synthetic asset in this depiction. And that is the number we're focusing on, because we're going to compare that number to the numbers that showed up in the actual carrier illustration cash value. We're going to look at the carrier illustrated cash value and then compare that to the account value net of loans in this fictitious hypothetical asset. But before we do that, we're also going to talk to the client and show them these reports here, where we talk about charges, we talk about credits, and we also talk about how these multiplier bonuses actually work in reality. So this page right here comes in our report, very extensive report. And this report is basically depicting, again, the worst 40-year period out of the 121 different 40-year periods that we model. And we see here that this synthetic asset here, this has a multiplier factor of 1.45x. And it starts in the second year of the asset accumulation. Okay, so that's the multiplier bonus. We also see that the multiplier charge in this particular synthetic asset has a 1% asset-based charge. And now that 1% asset-based charge is applied to the account value and then debited from that account value before the index credit is applied. And that's how it works in most IULs in reality. Now, as you see towards the bottom, the multiplier charge, bottom left-hand corner there, the multiplier charges get pretty substantial, right? Well over $1 million towards the end of this 40-year run. And when we compare that to what we call the standard charges, just one column over where you see $72, again, those standard charges were taken right out, that data was taken right out of the carrier illustration. Those are the equivalent to the policy charges in the carrier illustration. So if we look at the multiplier charges compared to the standard charges, they're pretty darn substantial. This right here is what the folks out there that hate multiplier IULs, this is what they're concerned about, okay? Let's take a look at this year that we just highlighted here, okay? S&P return, negative 23%. The index credit with a 0% floor would have credited 0. And so in any year that the S&P produces a negative return, obviously the 0% floor would kick in, but 0% times 1.45x is still 0, right? So you're getting 0 multiplier benefit, but you'd still get hit with the 1% asset-based charge, right? That's the hit right there. And that year is well over $1.5 million. If you look at the following year, in this particular run, same thing happens again, right? Then the year after that, there's a positive return. And then the year after that, there's another 0. But look at the positive return year, okay? Actually, before we do that, look at the charges in the last 4 years, right? In the orange section there, you got $1.5 million charge, which means that with a 0% floor, your cash value in an IUL, if that happened, would be reduced by $1.5 million in a 0% index credit year. The next year, you take another $1.5 million hit, and then skip a year, and then in the last year, you take a $1.7 million hit. So charges are quite a bit, but if we look at that 4-year period, where you have 3 zeros in that 4-year period, which is pretty adverse, basically, in that 4-year run, there were 3 zeros out of those 4 years. And in each of those 4 years, you're incurring a multiplier charge greater than $1.5 million in each one of those years. But in that 4-year period, the account would have received over $11 million in positive net gain. So this is just one example of what our software can mathematically model, again, that no other firm can model, right? Now, in fairness, this is a death benefit focused case. So one might argue, who cares about this stupid modeling accumulation, right? Who cares about modeling cash accumulation? Client's not going to draw down any cash anyway. So what value does this software even have when it comes to death benefit cases? Great question. Okay. In this graph right here, we track the account value in the hypothetical synthetic account. Okay. We track the account value in the best 40-year period of the 121 different 40-year periods. We look at the worst 40. And then we look at the account value using an assumption of a static 5.5% return, okay? Gross return. Why would we do this? Well, when we ran the carrier illustration, we actually used a 5.5% static return assumption, index credit assumption. So that 5.5 static line there was created by literally taking the exact same numbers out of the carrier illustration's cash value, which was run as under the assumption of a 5.5% index credit, right? That's the exact cash value as illustrated in the carrier illustration. Okay, but again, why is this relevant? Here's why. In the worst 40 example of the hypothetical account value, right, is very similar to the illustration's cash value for the first 15 to 20 years, okay, right in this area right here. Okay, now, why is that important? Several reasons, which I'm going to get to. But if you look at after that moment, right, the synthetic assets account value is actually greater than the cash value numbers from the illustration, right? Again, why does that matter? We're going to get to that. If this was a real world scenario, and if the policy's cash value was similar to that worst 40 hypothetical synthetic assets account value, right? If that was the actual cash value in a policy, it would stand to be reasonable to assume that the death benefit would be similar as the carrier illustration, as illustrated at 5.5% or greater, because the cash value relation to the death benefit is very similar for the first, call it 23 years in this particular depiction. Okay, and again, why is that so important? The reason this is so important in premium financing is that if the cash value performed worse than as illustrated due to poor market performance, poor sequence of returns, et cetera, in reality, the IUL's death benefit could be substantially less than was initially illustrated in the carrier illustration that you showed the client when they bought the policy. Well, if the premium financing design is not designed prudently, properly, responsibly, yeah, it may work in the carrier illustration, but if things get turned upside down and the policy in reality does not perform as well as in the initial carrier illustration, and the premium financing design with the loan to value and the interest rates and all of those other variables don't actually happen as illustrated, all of a sudden you can have a policy that's not only has a lower net death benefit than the client was expecting, that policy could go into lapse mode. And so this is why all this back testing becomes so important in premium financing, is because you want to be able to look the client in the eye and know that this has been actually stress tested with volatility, where we could actually see, okay, will this thing actually hold up over time? Without this software that we have at Landsmark Capital, it is impossible for you to even know this. Sure, you could run a carrier illustration with a lower index credit, but you're going to run it at a static positive index credit every single year, and that's not the same as showing volatility up and down. And if you're selling a policy with multipliers or high cap options or whatever, those additional asset-based charges are going to erode the cash value if you're not getting some good performance. And so this is why our software is so valuable when it comes to premium financing. Okay, I mean, wouldn't you want to know whether or not the premium financing design could withstand that kind of pressure? Landsmark Capital is the only premium financing intermediary that has the software to model this type of back testing. Okay, and lastly, something very few people ever get to see or understand is how participating loans work. Now, when you pay off a third-party lender in a premium financing design with a participating loan, you are essentially signing up for compound debt with the carrier, right? The question is that a mathematically prudent thing to do? Now, I will tell you, before we create all of our software, I was Mr. Anti-participating loan. We used to pay off all of our loans with withdrawals to basis. And the reason was I was always worried that, well, what happens if you're if the debt with the carrier on the participating loan, if that debt, that compounding debt outpaces the policy cash value growth? Well, it wasn't until we built our software where we can truly mathematically model what happens in times of volatility and poor market performance to see if this would actually work or not. So let's take a look at this. This is the worst 40-year period of the 121 different periods that we test under. We're paying off the third-party lender in year 20 to the tune of $32 million. That was the principal that went in. And we're showing the interest due on this participating loan using a 5% par loan rate. Okay, and so that is the interest that is accumulating and racking up that compound debt in a participating loan. And the hope here is that the index credit on this amount would outpace the compound debt. The question is, how do you know if that's going to happen or not? With our software, we can actually test this with the volatility to see what the index credits would have actually been during, in this case, again, this is the 40-year period with the worst compound annual growth rate out of all those 121 different periods. So in this column right here, those are the index credits that would have been received during that back tested period. So we see in years where there's a zero index credit, there are also $0 being credited. Again, remember, this is the worst 40-year period of the 121 different periods we model. Now, in this case here, this is the coolest thing ever right here, okay? The total debt on the account based on the participating loan is $89 million, okay? That is what is now racked up in loan debt with all of that accrued interest on that participating loan. But if you look one column over there, that 115 million, that represents the cumulative index credits by leaving all of that cash in the index, receiving that index credit every year. So if we look at the $89 million in compounded debt versus the $115 million in cumulative index credits, the client would actually be up $26 million in positive arbitrage based on that participating loan feature. That is huge, right? That's where that par loan spread really shines. Again, this is the worst 40-year period out of 121 different periods. There are 12 zeros in those 40 years, 12 zero index credits, 12 0% index credits. And in the first 10 years of this run, there were 4 0% index credits. And the par loan proposition still holds water. So again, if we go back to the graph, I love looking at the worst 40 and comparing the account value in the synthetic asset to the cash value numbers as illustrated in the carrier illustration. And in addition to that, I mean, we haven't even talked about this part yet, right? In the best 40-year scenario. In the best 40-year scenario, if we look at the bottom and the little legend down there, in this particular hypothetical synthetic asset that we're modeling here, in the best 40-year run, we can actually pay off the lender in year 16 versus year 20. So in that scenario, if the client could pay off the third-party lender with the account value in year 16 instead of year 20, that would reduce their out-of-pocket in interest paid, total interest paid, from $11 million down to only $6.7 million. So that's huge. Now, I know what you're going to say already, okay? Yeah, Darren, that's assuming the best 40-year run out of those 121 different runs. Fair enough. That's a good point. So let's take a look at the median 40, okay? The median 40. In other words, that means that of those 121 different raw S&P runs, 60 of those 40-year runs were better and 60 of them were worse. The median one is essentially the 61st ranked compound annual growth rate one. Okay, that's the median one right there. And that's with the third-party lender paid off in the 16th year. Okay, and there are the same numbers taken from the cash value and the carrier illustration, assuming the third-party lender was paid off in the 20th year. Okay, now remember, in the first 12 to 15 years of a real IUL, the policy hasn't even hit corridor yet. So the death benefit would still be maintained even if the cash value was a little bit less than as illustrated in the original carrier illustration. Okay, so what does this all mean? Well, what it means is that the carrier illustrations due to AG 489A are not going to be able to illustrate a premium financing loan to be paid off in years 15 or 16 like they were in the past. But it doesn't mean that in reality that the client couldn't do that, right? Assuming the policy performed and it was a reasonable par loan rate with the carrier. So remember, carrier illustrations are restricted to only showing a 50 basis point spread between the index credit and the par loan rate, which is completely, again, unrealistic. So again, in this example, the hypothetical asset paid off a third-party lender in the 16th year, again, almost cutting the client contribution in half because of exiting in year 16 instead of year 20. And again, that's at the bottom right there, highlighted in yellow. Okay. So as you wrap up here with a recap, again, why use Lionsmart Capital for your premium financing cases? One, we're the most educationally based, certainly educationally focused firm in the business. Our goal is to really help your clients understand what it is that they're buying when it comes to premium financing. And I'm telling you, once they see our analytics and they see how much due diligence we've done on their behalf, they're going to become raving fans of yours and they're going to refer all of their high net worth friends to you. Two, we're definitely the most transparent. All right. So we're showing essentially clients how the watch works, not just telling them what time it is. Now, I know some of you might be saying, look, Darren, my clients don't want all this detail. And while I know you may be saying that, and maybe in some cases you're right, maybe sometimes that's true, I will tell you this, all right? If you have high net worth prospects whose net worth is over $5 to $10 million, and you know they need a large life insurance policy, and you've shown them premium financing, and they haven't pulled the trigger yet, I'm telling you, it's not because of COVID. It's not because they're busy. It's certainly not because they don't have the money, right? Clearly they have the money. That's why they need a 10 to 50 to $100 million life insurance policy. They have the money. So why haven't they moved forward with you? I'm telling you, it's not because of COVID. It's not because they're busy. It's not because they're gone on vacation. It's because they actually do want to know how the watch works. You can argue with me all day long about that, but if they haven't pulled the trigger yet, there's something missing, right? They just don't trust that whatever you've showed them so far, they don't trust that it's going to work. They're worried about what happens if the market doesn't perform. What happens if borrowing rates go up? What happens if they have to post more collateral? What happens if ... That's what they're concerned about. That's why they haven't pulled the trigger, right? We always say a confused mind does nothing, or a skeptical mind does nothing, or a worried mind does nothing. Okay. Why? Why are they not moving forward? It's because in their minds, they have to make sense of how premium financing actually works. Not just this, hey, trust me, I'm a doctor type of sales pitch, right? Sometimes they actually want to know how the IUL is built. They want to understand the floors and the caps and the multipliers. They want to understand how the loan terms work. And they want to know if all this will work in a worst case scenario. Okay. That's where our proprietary software comes in. And I'm telling you, when we walk your high net worth clients and their CPAs through our software reports, their trust level and our competency goes through the roof. They are seeing this from an angle that they've never seen before, right? The optics on everything that we do just really inspires trust and faith in the fact that we've done our due diligence, and we're not showing them just a rosy scenario. We're showing them good, bad, and ugly, right? Emphasis on the ugly. And even in an ugly environment, if the premium financing design still holds up, they run out of reasons to not do this. And that is essentially where we want to steer the conversation with the client to at that point, where they say, well, we've uncovered every single potential gotcha. And this platform, this design is rock solid and will withstand the stress and the pressure, even in the worst 40-year period out of 121 different actual historical periods. Okay. Lastly, our custom strategies are really built to your client's specific and unique needs. If you go to our website, this is our homepage here. If you click on our programs in the very top of our homepage, it'll jump you to a page where we have a full description of all of our premium financing programs. Again, we have 4 different platforms. The one we looked at today on this webinar is called First Dollar Premium Financing. We also have the Omakase Pension Alternative. We have Leveraged Index Arbitrage. We have, again, 4 different programs to take a look at. And so when we start discussing your cases with you, we've got a series of questions we'll ask, and we'll be able to really custom build the premium financing design specific to your client's unique situation, unique needs, and all that good stuff. And then if you scroll to the bottom of our homepage down here, you can actually download the ebook version of our nationally acclaimed book, the definitive book on premium financing, the good, bad, ugly, and insane practices used in a controversial industry. You can also purchase the paperback version on Amazon, but you can literally download the ebook version on our website for free. You could do that today. So lastly, here as we wrap up, be on the lookout for our next webinar. I'm going to be taking you through an alternative way to finance life insurance premiums, very different than the First Dollar financing program we reviewed today. And I'll be comparing that strategy to the one I just finished explaining to you in this webinar. Because you may have some clients that want to use this one, the First Dollar financing one. You may have other clients that might prefer one of our alternative methods. So in any case, I'm Darren Sugiyama, one of the managing partners here at Lionsmark Capital. Hope you enjoyed today's webinar, and I look forward to one day meeting you soon, hopefully in person once we get out of this Zoom COVID environment. So again, look forward to meeting you guys soon. Enjoy the rest of your day. God bless you guys.